In this video, we're going to look at the stock market and macroeconomic variables. So we're just going to see how different kind of economic factors impact the stock market in the long run. I'm not going to get into too much detail on each one. It's just going to be of a quick summary of each of these factors here. So we have interest rates, inflation, employment, PMI, and GDP, and we're just going to see how it affects the stock market. So getting straight into it, interest rates. Now, the definition of interest rates, they are central bank decisions or government decisions that set the base level interest rates for the economy. Now, interest rates and stock market. So the direct effect affects the amount a company can afford to borrow. Interest rates, if interest rates go up, it makes it more expensive for businesses and consumers to borrow. Therefore, it leads to lower spending within the economy, which slows down the growth, which leads to weaker earnings. And of course, the same could be said vice versa if we inverse it. So if interest rates were low, we know that it is cheaper to borrow, so businesses and consumers would be spending more, which leads to more growth and higher earnings. Now, the indirect impact of interest rates on the stock market. It affects disposable income across the wider economy as the spending decreases and lowers the company revenue, which lowers the stock price also. So, onto GDP. Definition. Uh, GDP is the total value of finished goods and services produced within a country's borders in a specific time period, generally given on an annual basis. It's the gross domestic product. So we're going to look at how GDP affects the stock market. When GDP rises, corporate earnings increase, which makes it bullish for stocks. And when GDP falls, it leads to lower spending by businesses and consumers, which drives the market lower. So basically, higher GDP is good, lower GDP is bad. Not to overcomplicate it. Inflation. So the definition of inflation is the change in prices for goods and services over time. And inflation is something I think impacts pretty much, everyone. We can all kind of feel the impact of inflation on our daily lives. So how does inflation affect the stock market then? So as inflation rises, input costs, raw materials, stuff like that, increases. Consumer spending decreases as things become more expensive, and they don't have wages aren't increasing as much as inflation. So therefore, company revenue decreases and the stock market decreases. So we can see here we have a chart of a monthly 12-month inflation rate in the United States from April 2020 to April 2023. And we can see that inflation has come down significantly within the past year, but it is, I would say, relatively high, still near 5%. It was at a peak at almost 10%, which is unheard of, but it's glad to see that it is coming down a bit slowly but surely. Employment. Now, definition of employment measures the extent to which available labor resources, people available to work, are being used, typically released on a monthly, quarterly, and annual basis by government. So, employment and stock market. So, as employment rises, we see that consumer spending increases as more people have disposable income. Therefore, it equals to an increase in company revenue as consumers are spending more, which leads to a bullish kind of higher rise in the stock market. PMI. PMI is the Purchasing Managers Index. It's probably not as known as the other kind of variables that were in this, such as like GDP, inflation, interest rates, all that sort. So, definition of PMI. PMI is the monthly data derived from surveys of senior executives at private sector companies. It provides an advanced look at GDP, inflation, exports, capacity utilization, which is a fancy way of saying how business or economy uses its financial or capital resources to achieve economic growth. We're also taking a look at employment and inventory values. So PMI and the stock market. Investors use the PMI because it is a leading indicator of economic conditions. The direction of the PMI above or below 50 precedes changes in economic activity plus output, such as the GDP, industrial production, and employment. So if you look at a PMI chart, if uh, if it is above 50, it's said to be bullish or like achieve economic growth. Whereas if it's below 50, it's said to be a decline. And that's basically putting all of this into very simple terms, not going into much detail, but just giving an overview of how these different factors have an impact on the stock market as a whole. So, yeah.